Do you have a kind of firm handle as we go through this noisy pivot in the US economy as it picks up speed and accelerates with so many things coming together at the moment? What the story's going to look like 1 year from now?
Yeah, I mean, thanks for having me on. And that's a key question, I think, for investors right now. And it's one of the things we've been grappling with. I mean, if I phrase it another way, what I think we're asking is, if we look at the 2022 economy, do we think it looks more like 2019 in flavor or more like 2020, right? Are we going back to something that looked more like the pre-COVID economy? And I think the answer can really differ depending on the pocket of the market you're talking about overall, right? Over the course of the last year, we certainly saw a number of structural trends that were accelerated that are probably real and durable. Things like further adoption of e-commerce, adoption of telehealth, more working from home, all make a lot of sense, right? For other pockets of the economy related to services and out-of-home experiences, we're of the view, I think, that ultimately you do see some path to normalization. And I think as you go into the noise you mentioned, I think that's common in recoveries from recessions. One thing we like to track, for instance, is the volatility of the momentum factor. In other words, how big are the moves and what has been working? And when you see that volatility start to shift, when you see the momentum factor's composition start to change, it's indicative of an inflection point in economic activity. So whatever the cause of this recession, we're right on track for that recovery. And the market's trying to sift all this out, right? This change you're talking about in the leverage ratio, one example of normalization, I think, of the path there.
So is the trade going to continue to be, when I come into the office in the morning and see yields up, I should expect banks to also be up and tech stocks to be down? Is that just the new normal?
It's a good question, right? I mean, I think as yields continue to move, if the economy accelerates, there are a lot of reasons to think there's still further upside in banks, not least of which is yields, but you also have to consider that the consumer balance sheet is also in remarkable shape. Banks did take a lot of reserves. And as the economy reopens, we expect those credit losses that were kind of booked last year to be released and show some better credit trends. With tech, it's a bit more differentiated. I would look at who has the earnings power and where the expectations are not too high, which is what we've recently been trying to do in our work, and where the rate sensitivity is too maxed out, so to speak, where the long duration pieces are not, and where you have a bit of durable earnings power.
Adam, the market started front-running the recovery 9 months ago. And 2020 was an incredibly strong year for equities as a result. This year, 2021, is going to be a strong year economically. And everybody, including the Fed, is revising up its expectations for just how strong it's going to be. The problem is, though, that everybody then expects the economy to decelerate quite rapidly after that, albeit on a more sustainable path. Nevertheless, at what point, and I come back to that kind of 9-month story, at what point this year do you think the market starts looking beyond the stimulus, looking beyond the recovery? And what does that picture look like? Because, again, I come back to my first question. I don't know what that looks like yet.
Yeah, and we're trying to figure it out as well, right? So what I would say is earnings expectations on the S&P 500 have repriced fairly well. In other words, current earnings expectations for this year are something on the order of 7% above prior peak. So to your point, right, a lot of those bullish expectations are in the price. What I have to believe, what we believe as a house, is that the durability of the growth path is for real. So you may be decelerating, right? Obviously, you're going to be coming off of a fairly high growth period as the economy reopens. But beyond that, I think the growth path is fairly robust. And where we're really increasingly focused is looking for alpha opportunities, right? In those places tied to the reopening, at least over the next 3 to 6 months, where you can still surprise to the upside. Because I think, to what was implicit in your question, a lot of the upside at the index level may well be priced.
Adam, this market obviously is very much focused on the growth and inflation outlook. What everybody seems to have kind of put on the back burner is geopolitics. And we saw overnight the first meeting between the U.S. and China of the Biden administration didn't go terribly well. There's still clearly some animosity there. Do you think geopolitical risk is underpriced?
It's something we're watching, right? It's something we've written about in that on the path to normalization, policy has clearly been a key driver of the way there, right? The reopening of the economy, largely driven by policy, largely driven by fiscal policy to get checks out to the U.S. consumer to keep spending well supported. So I can tell you we will be focused as we get it later into the year on tax policy, but the exact parameters of that remain to be seen. And of course, there are a number of geopolitical themes you want to watch, like the U.S.-China relations, like perhaps green border taxes coming out of Europe, digital tax initiatives. All of that, of course, matters to the market mix. I think for now, though, the primary focus continues to be on reopening, quite frankly, and justifiably so, because we still have another few months of that occurring.